investors complicate investing and waste thousands of dollars in fees for no reason. I can recall being on the phone with investors, asking them their strategy and saying, "Why are you making it so complicated?" What if I told you that the best performing portfolios are actually the easiest? Actually, it's the investing that you do that's going to have a good return. If you don't have the time to research stocks, to analyze market trends, or to manage a portfolio, and all of those things have been keeping you paralyzed from investing, I'll show you 3 easy ways to grow your money even if you never check your investments. Investing should be boring for the long term. Now let's get into it. Think about your investings like your morning coffee. You could spend time grinding the beans, steaming the milk, pouring your perfect brew. Or you could just hit the button on the coffee maker, make you a great cup of coffee with less effort. And I'm all about working smarter, not harder, and I'm not a coffee snob. Who wants to waste time on that? The same applies to your investing. You don't need complexity in order to get great returns. In fact, Charles Schwab, one of the biggest names in finance, said that only about 1 in 4 portfolios actually outperform the stock market. That's why I'm a firm believer in the power of indexing. And that is why keeping it simple works. But before we get started on the 3 simple ways, I want to tell you about a conversation that I had with one of the students at an African health conference that I presented at recently. We were sitting around the table eating our lunch, and she said, "Brittany, I loved your talk, but I had a conversation with a friend who earns significantly more money than I will ever earn. And he told me that you should wait because you're just a student. Wait until you're actually earning money to start investing." And I hear this all the time. Many people believe that $10 a month, $20 a month, $50 a month will make no difference in the final amount of their investment portfolio because it's such a small incremental drop in the bucket. And so the recommendation to some and the approach of many is to wait until you start making 6 figures before you start investing. But I want to tell you today, you heard this here, right here from me, that is one of the biggest mistakes that you can make. And the reason why is because of compounding interest. Investing just $10 a month can equate to $12,000 later, with the majority of the accumulation of that wealth being compounded interest. And if you do this, investing just a small amount in a low-cost index fund, then that will help you to accumulate thousands of dollars over the span of years. Because if you wait, what you will lose that you will never be able to get back is time. And honestly, that's why these simple strategies work. You don't really need a lot of money. You don't need a lot of expertise, because once you get started, you will have the power of time on your side helping you to build wealth. You don't need to overthink it. You just need to start, and I'm going to teach you how to do that today. All right, strategy number 1 is target date retirement fund. This is one of the simplest ways to get ready for those golden years. And just set it and forget it. Literally set it and forget it. I want you to imagine that a target date fund is like a self-driving car. You pick the year that you retire, and the funds will automatically adjust and do all of the driving for you. The asset allocation will shift from being very aggressive growth stocks when you're just starting out to more conservative bonds when you are nearing retirement. And it happens without you lifting a finger. Basically, all you need to know and calculate is the year that you want to retire. For me, I typically like to choose a date that's a little bit farther than what is a typical retirement date. And the reason why is because as you approach retirement, as you increase in age, then your fund will shift from very aggressive to more conservative. And honestly, I want a few more aggressive investing years to maximize the growth. And there are really 3 reasons why this is a great option for many people who are just getting started today. 1 is that there's no need for rebalancing. The advisor will keep everything in order for you. 2, it is diversified across stocks and bonds, international and domestic so that you can get the optimal growth for you and also ensure that it is risk neutral. And 3, it works really well in 401ks and IRAs because even if there's a sale of stocks and bonds and that could lead to high turnover with the account, you will not have to pay taxes on that because you have put it into a retirement account that is tax deferred. But if you're somebody who wants a one-click solution, set it and forget it, then this is the option for you. And strategy number 2 is the one fund strategy, getting only the total market index fund. If you only had time to pick one investment, then this would be the one. You would purchase the total stock market index fund at whichever broker you love. I have used Fidelity, Charles Schwab's, Vanguard. They all have really great options and customer service. This strategy works so well because at the moment that you purchase this fund, you instantly are diversified. You immediately have tiny little pieces of the entire stock market. You get diversification over small cap, mid cap, large cap, and it's low cost. Some examples of total stock market funds could be the Vanguard Total Stock Market Index Fund, VTSAX, or Fidelity Total Stock Market Index Fund of FSKAX. It's like owning a slice of every major US company without having to handpick which one you desire. And because these funds have such low fees, you're going to keep more of your returns. Remember that quote from Charles Schwab. Year after year, time after time again, we see that investing in these simple funds can outperform any active management. And this is a great buy because there's no research required to just buy and hold. You don't need to track individual stocks. And historically, it has shown very extremely strong performance. And strategy number 3 is the 3-fund portfolio. It is diversified and it's simple. Now, if you want a little bit more balance, but you still want to keep things very simple, which is what, they say, KISS, keep it simple, stupid. I know you're not stupid, so keep it simple, smart person. And the 3-fund portfolio can help you to do that. This fund includes 1, the Total Stock Market Index Fund, and it covers all US stocks. 2, the International Stock Market Index Fund, giving you global exposure. And 3, the Total Bond Market Fund, that adds this additional layer of conservative approach that helps you to reduce your risk. Now, examples of these funds are the Vanguard International Fund and the Vanguard Total Bond Market Fund. With just these 3 funds, you'll get the total stock market exposure, international exposure, plus the reduction in risk that bonds afford. And there's no need for constant research and appraisal. This is investing on autopilot. And even though this is more than one fund in the target date retirement fund or the single total stock market fund, it is still only 3 funds to manage, which is still very simple. It is also very low cost and highly diversified, and it would be easy to rebalance once a year. You don't have to check your stocks and your investments every day, weekly, or monthly. I actually recommend checking in quarterly, see how things are going, not making many changes, checking in at 6 months and at a year, rebalance based upon the percentages that you wanted to allocate to each of these funds. I'm going to take you to my computer where we will compare each of these options and the holdings in them, the cost, so that you can make a decision of which one you want to purchase. The first is Fidelity's fund, and you just want to Google it essentially, or if you're not using Google, put it in Safari to bring it up. Another way to do it is just go directly to Fidelity's website and then type in the abbreviation. Here I'm going to click FSKAX, Fidelity Total Market Index Fund, and we're going to evaluate their summary. Here you can see at the top that you have the abbreviation here in the search bar. If you want to search any other Fidelity fund, then you can just put its abbreviation right here. Then you have the name and making sure that you fully understand what you are looking at on the summary. Next, you have this NAV, and basically what this tells you is the cost to purchase this fund, one share of this fund right now, and you can also see the change that has occurred. And next, under the summary sheet, you can see the Morningstar snapshot and the overall ratings. So out of 1,275 funds, you get a rating overall of about 3 stars. The expenses are low, and then the risk for this category is a little bit higher risk, but it's really in the medium range. Now we're going to take a look at performance. 1, 3, 5 years, 10 years. For the 1-year performance for this individual fund is about 17.50%, where the 10-year return on this fund is 12.3%. It's a little bit more than what we typically think about the stock market performing annualized over 10 years. But we know that recently we've had some really high returning years, and there's going to be a correction. So whenever you're thinking about investing in an index fund with any of the brokers, Fidelity, Vanguard, Charles Schwab, you want to see how closely their fund mirrors what you are measuring. And so here are the indices that we're looking at. One is the Dow Jones US Total Stock Market Index. You almost cannot see a difference in the lines here. Typically, this suggests that there's overlap of what is FSKAX and what is the Dow Jones Total Stock Market. Here are some of the details. The fund started in 1997, the share class inception of 2011. But what you really are interested in is this number here, this expense ratio. The expense ratio is 0.015, which is really good, which means that on, let's say, $100,000, you would pay Fidelity $15 by purchasing this fund. That is a very low cost index fund. And this is what we're talking about of keeping more of your money. We already talked about the net asset value, which basically is what is the value of the stock today. And essentially it is $156.88. This is also a measurement that you want to look at, especially as we're talking about starting with $10. Like literally you can start with $10 today purchasing this fund, because minimum to invest is $0. So you can start with 50 cents if you wanted to, just to practice to build that confidence. And then you have this turnover rate. This turnover rate is really important because this is where the efficiencies of taxes come in. Ideally, you would want to keep this turnover rate low, like under 20 to 30%. If you purchase this fund in a taxable account, remember you will have to pay taxes every time they make a sale for a profit within this fund. You want to reduce the amount of taxes that you're going to pay to keep this fund. Then you'll see the portfolio net assets, and this is how much is in the portfolio right now on a scale of millions. 106 million, and then the 12-month low and high range, $136.45 to a high of $169.55. Looking at his top holdings, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla, and the list continues. This is one way for you to invest and diversify and have all of the total stock market get great returns at a low cost, right? Low cost with the expense ratio with a low minimum investment, and still be completely diversified, still be an investor in capitalizing on compounding interest. Now, I just want to compare that to the Vanguard Total Stock Market Fund. I just Googled this VTSAX and it came up here. So you're just going to click on this and go to Vanguard's website to evaluate their summary of this fund. You can see that Vanguard has a little bit of a different layout of their information. The first thing that they want to highlight is that this is a management style of an index fund. This is not a fund that is going to be actively managed, that is going to follow the index. And then the asset class is domestic stock. So we're not looking at international, and most of the category is large blend. The expense ratio is 0.04% compared to Fidelity's that was 0.015%. So you're paying a little bit more. Looking at the price, this Vanguard fund is $137.24 per share right now as far as the net asset value, and the investment minimum is $3,000 compared to an investment minimum of $0 at Fidelity. This is a mutual fund. If you want to purchase a lower cost on Vanguard's website here, also available as an ETF, right? An exchange traded fund.
So this exchange traded fund gives you the option of starting at the price of $1. Because I want to compare apples to apples, right? We don't have millions of dollars or even thousands of dollars to start investing. Let's click over to that one. And now when you click over to that one, you can see that this now starts with VTI. Okay, so that is one of the things that you see, but it's not a mutual fund. This is now the ETF. And looking at this, that it has an expense ratio of a little bit lower, so 0.03%, still higher than Fidelity, but also very affordable. And the price of each of these shares is more expensive. Right now, it is valued at $281.94. And you can see the market price. This is the price right now. If you're going to buy it right now, $282.01. Now let's look at the performance. We're going to look at the performance and fees for Fidelity's fund. And you can see that the 1 year is 17.42%. And that is compared to 17.5% annual returns of Fidelity, 11.51% compared to 11.54% for Fidelity, 16.06% compared to 16.05%. You see that both of these track the index pretty well, and their returns are almost about the same. So since inception, about 8.88%, which is what we expect the stock market to typically return. As you can see, both Vanguard and Fidelity offer a really nice blended fund that is diversified, that is low cost, that is accessible with either 50 cents or $1.
Now that you know about how to invest simply, let's talk about what not to do. And the first thing not to do is waiting to get started. I'm sure you've already guessed that with the story that I told you. Even small amounts add up over time. And don't wait until you have the perfect salary, until you feel so confident that you know everything about investing or that life allows you to put a little bit more in. Starting investing now, even if it's just $10 a week or $10 a month, can lead to significant gains over time. Another thing not to do is to pay high fees. Many actively managed accounts have 1% of the assets under management that they're taking in fees. No, you're not writing a check, but it's still money that is reducing your return on investment. And honestly, it can lead to hundreds of thousands of dollars over time. And if you're not involving an advisor and you're picking the stocks, the funds yourself, you want to make sure that you look at a low cost index fund, ones that are going to be about 0.1% or 0.15% expense ratios, and try to avoid going higher. And another thing to avoid doing is trying to time the market. Studies show that time in the market beats timing the market every single time. Even professionals fail to know when to sell and when to buy. The approach here is to just buy consistently. And you also want to avoid ignoring asset allocation. If you're younger, you want more stocks. That's why I choose a date for my retirement that is later than the date that I actually want to retire. And as you move closer to retirement, you want to choose bonds and make your allocations a little bit more conservative to reduce your risk. So I got a question for you. Which of these 3 strategies are you going to start and employ today?
Let's not wait to get started. You can get started today at a very low cost. And what this allows you to do is to maximize your time, maximize the value, and not have to be super concerned about finding a financial advisor to do this for you. This is really easy, something that you can do yourself. And I would encourage you to start today. If you have any questions about anything that I talked about, any of these funds, then let me know in the comments, and I will see you in the next video. Bye-bye.